Hi everyone, welcome to Crypto Arcade, and this video we're going to go over the anatomy of the price chart. So what does the price chart represent? Well, it is a visual representation of an asset's price over a period of time. So here we're taking a look at Bitcoin, and we've got the x-axis along the bottom, we've got the y-axis which runs vertically along the right-hand side. The x-axis represents time. So here we can see prices going back to May or April of 2020, and it goes all the way here to the right at February of 2021. So the charting packages of today are a bit interesting. You can actually play them forward and do some various different things with them. So as what we're seeing here is as time moves forward, we're seeing the price of Bitcoin move up and down, and that's the y-axis. So the price is moving up and down. We're seeing this series of price relative to time. And so more or less, that's what you're going to get with the X and the Y axis with Bitcoin. So 100 years ago, charting has not always been this way, because 100 years ago, we didn't have these fancy softwares that would go out and map all these prices for us. So 100 years ago, they would have looked at, or actually they wouldn't have looked at it, they would have created, a trader would have had to create a chart on their own that looks something like this. And the way this would happen is they would go down to a local brokerage type shop, and then they would have somebody read off the prices on the tape, and then they would pay attention, and based on what they were hearing, they would mark and be able to identify certain key levels, certain price levels that were very important. And so the important thing to remember is that 100 years ago, they did not have access to every single price that was being run on the stock market at that time. And their chart would have looked something like this, and they would have had to draw this up themselves. They did not have fancy computers available to help them out. So today, we get the benefit of looking at something like this, where we can see all of the prices that have been funneled through, and we get them pretty close to real time as well with a very small delay, an unnoticeable delay. So the next part that I want to cover here is the chart time frame. So every bar, you'll notice that we've got a series of data points on here. Let's look at this big red candle. This is called a bar. And so in this case, every bar represents 1 day's worth of time. So it's a 24-hour period. Now, what's important to remember and understand is that 24-hour period, it's not a rolling 24-hour period. There's an actual start and an actual end time to this 24-hour period. So this candle is going to look the same today as it will tomorrow and the next day. This candle for September the 7th will look the same. That's because the beginning and the end time of that day's period is etched in stone. Now, crypto trades 24 hours a day, 7 days a week. So they're technically, the market does not close. It trades all of the time, even on holidays. And so what brokers will do is they'll create an arbitrary close time just so that they can create these charting, basically be able to create the chart. So some of those close times may be different from broker to broker. Some of them may be GMT 0. Some of them may be based on New York time or based on London time. So you just want to pay attention as to when that closing time is for that particular chart or broker. But here, every one of these bars represents a 24-hour period of trading. And we can change that. We don't have to follow that daily chart and 24-hour period. We could change it to a 60-minute period, a 1-hour period. So here, every bar on this chart represents a 60-minute period, and it begins at the top of the hour and it ends at the top of the hour. And so you've got daily, hourly, you've got all these different kinds of minute charts. We could look at a 15-minute chart. Basically, the 15-minute chart shows us what the price action was for that 15-minute period. So there's going to be 4 of those 15-minute periods that create the hourly chart. So chart time frames. You've got monthly charts. You've got weekly charts. You've got daily charts, hourly charts, minute charts. The monthly and the weekly charts are going to be used more by the long-term hodlers for cryptocurrency. The daily time frame is going to be used more by a swing trader, somebody who is looking for some good trends, but it may take a couple of months for those trends to develop. And so that's going to be your swing traders. The minutes time frame is going to be used more, like a 15-minute or a 5-minute chart. That's going to be your day traders and your scalpers. So they're looking to get into and out of the trades fairly quickly. They might hold on to a trade for a day or two, but for the most part, they're going to be in and out of those trades and maybe even doing multiple trades in any given day. So that's your chart time frame. And notice as we change this chart time frame, so here we're taking a look at a 15-minute chart. Notice what happens to my time scale along the bottom. My time scale has to adjust as well, so that every one of these bars represents 15 minutes. And so I really have to zoom out on this 15-minute chart, and this will take me back to September the 24th. This is what the 15-minute trend looks like for September the 24th. But if I come down here to a 4-hour chart, September 24th was basically close to this bottom right here. So all we could see was that 15-minute chart. So that's why the day trader and the scalper is going to be interested in the minute chart, because they're not going to care about what the pattern was back here in the past. They're going to be more interested in what the near-term trends are. Whereas a long-term trader or swing trader, they want to see more of the trends taking place. And so they want to see more of the price history going on. So now let's take a look at the different types of charts. Let's start off with the line chart. And let's do a 1-hour line chart. Okay, so here we just have a simple black line. You can change the color of this. The charting packages are very versatile in allowing you to customize the colors of it. But we've got a line that just runs up and down. Same thing. You got your time scale along the bottom, your price scale along the right. And in essence, we've got one data point for every time period. So in this case, for a 1-hour time period, for that, which is called a bar, for that one bar, we're getting one data point. And that's the last traded price for the hour. So at the end of every hour, this data price point is going to update, it's going to finalize, and then it'll move forward one step, and then it will start grinding through the next hourly bar. So line charts are great for the simplicity because you just have the one data point coming into play. That was improved upon when they came up with this bar chart. Okay, so the bar chart looks somewhat similar, except for we've got a little more movement to the up and the downside here. And within every bar, we've got 4 data points. So let's take a look at this October 17th, this long red bar right here. You can see you've got little lines moving off to the left side of the bar. You've got little lines moving off to the right side of the bar. And in essence, what those represent is the line to the left represents the open price of the bar. The line to the right represents the close price of the bar. So we can look at this bar. We can see, hey, this is the price where it opened. Looked like it went up just a little bit, traded down for the hour, and then traded off of that low and came back, and that hourly candle closed right here. So we now have 4 pieces of data points on each of these bars, which can give us a little bit more information as to what was going on with the trading within that bar. So for example, let's look at this guy right here. Okay, this guy, I can tell by looking at it, it opened right here at about 62,245. And then it traded up it traded up to a high of 62,679, and then it traded down to a low of 61,790, and then ended up closing at 61,892. So if we were just looking at this on a bar chart, okay, if we were just looking at this on a bar chart, all we would have seen is a spot down here. And comparing to the previous spot on the previous hour, it would just look like a down candle. But by looking at the bar chart, we can see that when prices opened up, it actually traded to new highs, higher than anything we'd seen in several hours, and then it ended up falling, which is a very bearish symptom. Well, guess what happened after that? It continued to fall lower. And so it's those types of clues that we can pick up when we are looking at these types of these different types of charts. Now, a bar chart was improved upon with the candlestick chart. It's the same 4 data points: the open price, the high price, the low price, the close price, but it's just more visually appealing. We filled in the body of the candles with a red or a green color just to make it a little quicker for the eye to capture the essence of the trend. So we can see here, big green candles means we got a really nice strong uptrend. We got some red candles here, means we've got a downtrend. But it's the same data points. When you hover your mouse over any particular candle or bar, if you look at the top, you'll see an O. That means that the open price in this case was $59,342.97. The high price was $60,695.07. The low price was $59,308, and then the C represents the close price. So those are the 3 types of charts: the line chart, the bar chart, the candlestick charts. You got the various time frames of which you can do the charts with, depending on the type of trader that you are, and how to read the chart. So that's the basic anatomy of a chart. Now, in the next video, we're going to go out and we're going to talk in general terms, what are some of the tools that we're going to apply to the chart. And so we will see you in the next video.